Wendy's stock is down 50% in the past year. Is this stock a buy now after this pullback? Let's review Wendy's stock together. We can take a look at popular valuation multiples to see where Wendy's trades at today compared to itself in the past. We can see Wendy's trades at a discount from a price to sales, EV to EBITDA, and price to free cash flow perspective, which can make Wendy's look like a compelling buy today at a glance. Assuming these average price to sales and price to free cash flow multiples, we can try and estimate what the market cap of Wendy's could be given the 2025 outlook figures provided in quarter two results. Wendy's guidance estimates global sales growth to be -5% to -3% and free cash flow to be $160 million to $175 million. Assuming these guidance figures and the average price to sales ratio of 2.2 and price to free cash flow of 19.6, we can assume a market cap of 4.8 to 4.9 billion using price to sales, or 3.1 to 3.4 billion using price to free cash flow. These market caps translate to $16 to $18 or $25, which is much better compared to Wendy's stock price today at $9.21. Wendy's trades at a discount when compared to competitors as well. Wendy's, according to TIKR Terminal, has an EV to EBITDA of 10, while McDonald's trades at 17, Starbucks at 19, Chipotle at 21, and Yum Brands at 18. Same story for free cash flow. Wendy's trades at a price to free cash flow of 7.7, while much of the industry trades between 20s and 30s. Does revenue and free cash flow move the stock? Well, it does not seem like it. Ever since 2021, Wendy's revenue versus market cap has been inverse. As the revenue has gone up, the market cap has gone down. There is a divergence between the top line and the market cap. Free cash flow versus market cap also follows the same story. Annual free cash flow went from 215 to 260, but the market cap is down from 5 billion to 3 billion. So from a price to sales and price to free cash flow basis, yes, Wendy's trades at a discount compared to the historic average and against competitors. But is there something else driving down this stock right now? Maybe it's because of the heavy debt load. Wendy's stock has 2.6 billion in long-term debt, which can be expensive to finance as interest rates increased since 2021 from near 0% to now 4.3% federal funds rate. But this heavy debt load could not be the sole reason for Wendy's stock decline. For example, McDonald's has 58 billion in total liabilities, way more than the cash on hand, and the stock is up since 2020. In general, most publicly traded restaurant chains, quick service, fast casual, casual dining, carry a significant amount of long-term debt because franchise-heavy models like McDonald's, Wendy's, and Yum Brands use debt financing to expand locations, repurchase stock, and return capital via dividends. Also, fast food is a low-margin industry. Restaurants operate on thin margins, making equity issuance less attractive versus debt. So if Wendy's is not trading lower because of high debt loads, then why is Wendy's trading lower at all? Wendy's is trading lower because of declining same restaurant sales growth. This chart shows Wendy's closing price versus the same restaurant sales growth per quarter. We can see as the sales growth declines, so does the stock price. After all, if the restaurants are seeing and selling less quarter over quarter, then that will eventually bleed down towards the bottom line. Wendy's is losing foot traffic. Wendy's was growing 10% in sales back in 2021, but now Wendy's sales is declining 2.9% in the most recent quarter, causing investors to lose faith in the company. Wendy's will have to turn the tide around and find a way to get people back in the door. Meal prices have increased a lot lately, causing many to lose interest. It also does not help that input costs are going up for Wendy's as well. The cost of beef has gone up 50% since 2021. Instead of just looking at the stock price versus the sales growth percent change over time, we can see this as a scatter plot. Here we see the sales growth percentage and Wendy's stock price change quarter over quarter is correlated. We can draw a polynomial trend line to capture half of the variance. This high correlation shows that investors value this metric. If the sales growth is declining, then investors will lose confidence. Wendy's provides global sales growth guidance for 2025 at -5% to -3%. These guidance figures are for the full year 2025, so we will need to see what percent changes need to occur quarterly to get an average sales growth percent change in 2025 of -5 to -3%. Quarter three and quarter four, we could experience -6% sales growth to get an average 2025 sales growth of -3.2%. So let's plug in 6% to see what Wendy's stock price might be at. We can plug in -6 into the polynomial equation to estimate closing price percent change of -22%. These are quarter over quarter percent changes. Wendy's stock price was at $11.42 for quarter two, and a 22% change in price would become $8.93. So the stock could decline another 3%. Currently, the stock is at $9.21 to fully capture this guidance outlook, but it seems like the stock pretty much has priced in this 2025 full year guidance already. So, how might Wendy's go up in stock price? Wendy's will have to prove that sales growth will increase higher than the guidance provided in quarter three or quarter four. Current headwinds are inflation and consumers cutting back on expenses, along with input costs like beef rising as well. So, what is my final thoughts on Wendy's stock? I believe there are better positions to entertain compared to Wendy's. Wendy's will have to first prove they can pivot sales growth in the right direction. This trend has been going down for the past 4 years now. For example, I think Amazon is a better position to add into. It's been a lagger compared to the Mag 7 like Apple and Google and Nvidia. However, I can understand the appeal into Wendy's. It trades at a discount compared to peers and historically to itself, and Wendy's pays out a great dividend. However, I will flag about the potential value trap that Wendy's could be in, given that the high debt and dividend percentage that they pay out. Frankly, I think I'd prefer to see them pay down that debt rather than trying to pay out a large dividend percentage to make their balance sheet a bit more healthy. And if you're chasing for the dividend, you might want to consider a different vehicle like the Charles Schwab dividend ETF SCHD, a diversified ETF, and I think the dividend yield is like 3.64%, something like that. So, because I've been adding to that for my own personal journey. If anything, Wendy's may be a small position in my own personal financial journey as a turnaround play. Since the stock is already down 50%, much of this weakness in sales is priced in, and I don't think Wendy's is going to go away anytime soon. It's just a matter of if and when management can regain back the customer. I hope you enjoyed this video about Wendy's stock. Let me know what you think about the stock itself, and I will see you all in the next one.